Well. What a day in the market. A lot of green. We have a deal coming, possibly, but I'm not getting my hopes up. But it seems I made a post on this earlier. Um, it seems that Trump is willing to finally bend the leg and just pretty much give Iran what they want. I noted they're probably going to get the sanction release on oil. I mean, we need more oil flowing through the system, so it makes sense. And we did it to ourselves. And then two, uh, it looks like they're going to probably just begin building a new strait. I can't remember what country said that they were going to start doing that with, but I know they've said it in the past, so that is my reasoning for why they're probably going to allow the transit fees from happening. Now, done talking about that, but I wanted to get that out of the way since the markets are pumping. And the second reason, as Zeta right now is at 24.40, it continues to pump into earnings. $25 is the resistance we have not been able to cross. And it's still going up. We might actually end the day at a 10% day at this rate. But so let me go. I'm gonna pull up my article real quick. I want to talk a little bit about the numbers I gave. And if you guys actually did go and read my article and go through the numbers, comment. Let me know what you guys thought. I want to hear your guys' thoughts. Like, I have fun writing these. It makes it more fun to do the research and figure out what numbers I expect. And then it also allows you guys to see my reasoning. I think in the past, not like too much, but you'll see like comments and people think you're trying to hype up a stock when I say like I expect 46% revenue growth. So this is my way of being able to show you guys my thought process in coming up with these numbers, and then you guys can decide for yourself whether you guys think I'm BSing or not. And me personally, I try to be as accurate as possible because I'm not here to pump the stock. I'm here to provide information, and I think it provides credibility the closer I can be. So, just to get out of the way, like, none of these numbers are to, create hype, get people following me because of FOMO or whatnot. It's truly what I think. So I want to start off with what management told us. And management told us to expect 419 million to 422 million. And that gives us a midpoint of 420.5 million. They guide with a 2 to 5% cushion, but take that with a grain of salt. They last quarter were guiding for, I believe, 38% growth, and they came in at 50%. So even if they tell you 2 to 5% and you think, okay, their model's probably pretty accurate after that, they've proven to still be able to go above and beyond. So it's not as simple as, okay, just add 2 to 5% more from 420.5, and that's going to be what they do, so I must be wrong. No, that's not the case. And they proved that last quarter, and they proved that in previous quarters. So they're guiding for 36 to 37% year-over-year growth. That is not organic. I have about 10% above that. Last quarter, they did 12% above what they said. And no, that's not how I came up with that thought process, but for anyone who'd say my numbers, once again, are way too high, well, last quarter, they even beat my current percentage that's above their guide. So they're guiding for adjusted EBITDA of 86.2 million to 86.9 million, which is an adjusted EBITDA growth of 47 to 48%. Okay. And then their free cash flow. They didn't give us free cash flow. They just have the full year number. And if I can find that real quick, it's at the bottom of my article. Well, yeah, I could share my screen. Yeah, then you guys can see it. The full year number that they gave is 234 to 236 million, and I'm estimating about 51 to 54 million, and a lot of that's mainly because Q3 and Q4 tend to be their biggest quarters, and I was also conservative because I have this as a big customer acquisition quarter, like compared to most quarters. With the with Athena rolled out for the first full quarter, and also now in my head I also think Q3 will be pretty big, but Q3 and Q4 are usually the quarters that we see the most spend, and a lot of it Q4 it makes sense. Not football season, but yeah, football season, and then you have Christmas season, and then I think Q3 is a lot because you still have it's leading up into holidays, but football season I feel like drives more ad spend because everybody sits on their couch on a Sunday and watches the NFL in America. So uh, those are my reasons. But we did just have the FIFA World Cup, so I think Q2 in that sense is also why we could see a lot of spend. And so I got a 452 million revenue estimate. That's 46% growth, 4% less than we saw last quarter. I have the core accelerating to 24%. Big reason, FIFA. You have companies looking to get on the global stage. So ad spend, getting ad slots in there is super expensive. And then we have super scale. Okay, so they're guiding for 1.7 million in ARPU for super scaled. I have 1.78 million. It's me predicting that they're going to lean into ad spend, like I said. So let's go take a look. Zeta today. Let's talk about it. 24.44. Boy, oh boy, man, it's gone up the last 3 trading days. Hold on. Why am I looking at that? Last 3 trading days, if I can remember how to use my stupid platform, we are up 15%. In my portfolio yesterday, it was up like 12%, and now it's up again like... Okay, my options must have just... I have a bunch of options on margin just updated because it went from up like 9% to up 6%, but all my tickers, SoFi, HIMS, and Zeta, you can see they're at like all-time highs for the day. So I think one probably just pushed a new high and it messed it up. Oh, it's definitely because Zeta's pushing new all-time highs. So that's going to readjust. But, and I think it's right before earnings because I was looking. I was trying to buy back my cash secured put on, let me make myself bigger again. I was trying to buy back my cash secured put of $20 on Zeta, and even possibly my 22.5, because they're not till 2028. So I have like no concern in the world for them. I wanted to buy them back and flip them on to SoFi for the extra premiums. But because it's earnings day, I assume, I'd make no money. I think I would actually lose money by doing that, even though SoFi at its current price is underwater and Zeta is like $4 to $2 higher. So we'll see tomorrow. If we pump and rip, I'm going to look at possibly buying those back again and putting them on the SoFi. It's just a way for me to put more cash in my account. I'm not concerned about either one of them exercising, so it's not like me trying to avoid something from exercising. It's fully just me trying to collect premium where I can. And even possibly if I just want to get more of a margin buffer, I could realistically put it on like an $18 and like maybe take no cash. But then I have more margin flexibility. And if you guys know me, I do use margin. I try to be very, I'm not Leopold, not trying to Forex leverage my account. But in a time like this where things have been so exaggerated, you guys know I hold HIMS, I hold SoFi, I hold Zeta. Things have been so exaggerated that it just made sense. Like, you're going to tell me that SoFi at like a 25 PE growing 40% can really go much lower. Much lower. Like, I see like TA guys will say whatever, and it makes sense based off the chart. And this is not me dissing TA guys because I think TA is really smart, but I do think some they ignore fundamentals and they only look at a chart. And I learned very early on that is a quick way to lose money. When I first got into investing and like seeing these swing trading things, a TA guy is the first guy I looked at, and I didn't know anything about fundamentals. And so I got caught up in just looking at these charts. I'm like, oh, this chart's perfect. Oh, everybody keeps telling me this chart's perfect. Oh, it looks perfect. And many times the chart can look perfect, but if the fundamentals don't make sense, it's going to collapse, or it won't do what you say. Like when I hear someone tell me, and this is a true story, someone told me Zeta's going to like single digits. You aren't sending a company growing 50%, about to become profitable, to a 1 billion market cap when they do 2 billion in revenue. Like it's like doesn't make sense. So there's common sense involved, and I don't know who needs to hear that, but I had to go on my spiel because if I can help one person understand that, then I did something. So I wanted to share that. But anyways, we got 4 minutes until the markets close. Then we got earnings to drop at like 4:05. So ready to release that. Also, let me know. Tell me if my mic sounds quiet. I'm trying to propel my voice, but my mic's a little bit over here, but it should be good. So let me know if there's any audio issues, and I'll correct them before we actually get into anything real. I could even pull it up on my phone if I need to. We also, I think we'll have a guest. I don't know if you guys know who Joseph Invest is. I'm pretty sure Joseph Invest is his exact username. He's also known for his Fort Gamma account. Yeah, Joseph Invest is the correct username. He's known for his Fort Gamma account. He will be joining us a little bit later. He had an internship, but he's also a Zeta shareholder, and so we thought it would be good to kind of, we always see these big accounts, Amit, Tanner, they're always collabing, so it'd be cool to get, the retail community who are grinding as some reply guys to try and gain some traction, continue growing community, so I wanted to have him join me, and we've actually been discussing some things behind the scenes, so stay tuned for that. We have more coming, and yeah, I'm excited for that. We got 3 minutes, and then we are live. Also, I'm curious, how many people watch me on the TV? Because I always watch on TV, so I never comment. So if you don't comment, I'm assuming you're watching me on TV. So don't worry about commenting if that's the case. But if you're actually at your phone or a desktop, just comment real quick and tell me that you're at a desktop or like where you're watching me. Because I'm actually kind of curious because I don't know. I wonder that sometimes. And also let me know, this isn't an AMD thing, but I know we have a lot of AMD fans. If you guys want me to pull up their numbers real quick, I can. I personally don't know, like, outside of the fact that they sell chips and GPUs and, like, you need them for the build out. I don't know much about AMD. I know they've always specialized in inference from the very beginning. And so I think that's a big part of the bull case that people have when, because like I've heard people say like, oh, they expect NVIDIA's margins to crunch, and so I don't know if it's like a done deal that AMD has better inference, and so that's like the next one to run. But I don't know. I still just believe NVIDIA. They're so embedded in everything that they will continue being the best option. But if you guys want me to pull those numbers up and we can just look at them real quick, maybe I can get some AMD fanboys to tell me about it, because I'm sure it won't take us too long to look through the presentation. We'll look through the presentation and the call will start at like 4:30, so I believe it's at 4:30. And I will try to not do what I did last time. I mean, you guys will catch on to it. Last time I looked at Zeta's earnings by myself. The Q1 wasn't popping up, so I was messing with the year thing. And then I realized like halfway through that I was listening to the Q4 earnings call instead of the Q1. I was heated. I don't even think I ever went back. I was just like, yo, like, I heard, and the reason I called on to is, like, I was like, yo, like, this is the same number. It was some sort of metric, like, number metric, and I was like, wait, that happened in, like, Q4, and then I looked, and then, yep. But Zeta officially closes at 24.25, 24.33 right now. I can show the chart. We can see if it starts moving like crazy or not. Numbers should be at 24.42, so it's already starting to move. 24.47, so we're getting excited. I have the earnings correspondent up. You already know he's always on top of it. But low-key, I'm just going to pull up the tag because it's going to just show up in the latest. And I don't know if that page is going to, update right away when he posts. So I'd rather have it up here. Oh, yeah, we're going for 20 beat-in raises in a row. 20 in a row. I want to know what you guys are expecting. I can't wait to get Joseph on here. Okay. I thought that said 24.73. My thing got in the way. I was like, no way that thing updates for after hours. 24.60. We are pushing 25. 24.60. If you're in here, let me know how much you guys were up on the day. I want to know. I'm curious. I'm actually, like, oh, my bad. Turn the light off. I'm just pulling up YouTube on my phone, muting it. I can see who's in here better. Volume down. Close. Alright, bet. So we're at 24.47. Moving a little bit. Waiting for these numbers. We got Wealth Matica and Ronnie live. Ignore that. Okay. Any moment we should get the numbers. Let me know if you guys are in here. My dog's coming over to say hi. What you guys are expecting. What revenue growth are you guys expecting for this quarter? You know my estimate. We got 46%. We got, what was it, 352 million, and we have 6 cents of GAAP EPS. We have net income positivity. I didn't even think to mention that when I was talking earlier. That is big. And low key, I want to make sure you guys can hear me. We got, what was it, 352. Yeah, you guys can hear me. Alright, bet. So yeah, we got 352 in revenue, 6 cents of GAAP EPS, which I believe, if I remember correctly, that results in 13 million net income. That also puts us at flat. So then that would give us Q3 and Q4. All that net income would go to full year, and so we could realistically be looking at 18 to 20 cents EPS by the end of the year. Right now they're guiding for like 4 to 8, 4 to 6. And you know them. They always sandbag. So we'll see what happens. It is 404. Once these numbers come out, I am going to take a second to tweet it out. I got to make sure that all my followers see it, even the people who are, whatever they're doing, being lame. No, I'm just kidding. But I got to make sure I tweet it out. And then, yeah, during the earnings call, I'll mute myself. That way I don't yap. I'll be muted. And I thought maybe David Steinberg tweeted it out. But yeah, I'll mute myself. I'll let us listen to the call fully. And then I will save any of my thoughts until the very, very end. And any minute, it is 4:04. This thing should be updating with the results. Come on. And then also, once we get these results, I'm going to SpaceX. What did SpaceX do? SpaceX just reported revenue of $7.81 billion, beating their estimate of $6.82 billion, and they were just negative 9 cents EPS versus estimate of negative 23 cents EPS. Low key, if this, okay, we have no numbers on Zeta right now. I want to see if SpaceX is pumping. SpaceX is down 1%, which honestly they were up so much today you can't even be mad. And they're like what, worth $1 trillion? So wait, we just reported 443 million, beating 420 million, 44% year-over-year growth. I had 46%, and they did 3 cents of EPS. I had 6 cents of EPS. That is a beat all across the board. Yes, I was overly bullish, but I was still on the same track. I was wrong by 2%. Here we go. Let me just tweet this out real quick. Let me full screen my thing. Hold on. Zeta Global. Oh, shoot. I hate when that happens. Zeta Global beats earnings. Revenue. Hold on. I gotta pull it up on this. I don't have great memory. I just remembered the 44% number. And it never lets you click on the image when you're like in it, which sucks. So yeah, 442 million. $442 million EPS. Dollar 0.03. What's the stock doing? The stock tanked. We're down 8%. Okay. What is new? What is new? I could care less though. We're about to dig into this report. Zeta Global beats revenue 542 million. Yes. All right, let's dig into this. I'm about to pull it up. Okay. Let me see if Joseph is getting in here or not. I keep hitting that. All right, bet. See, this is what happened. Oh, there it goes. Presentation. Okay, Q2 2026. Forward-looking statements and non-GAAP measures. So they did 443 million revenue, 44% cash from ops, 69 million. Adjusted EBITDA of 92 million. Let me pull up that article because I have everything already laid out. So I want to be able to see everything in which I was expecting. Or just what they said and then what I had. So they told us adjusted EBITDA of 86.2 to 86.9. So they beat on that. Wrong thing. It was 92 million, adjusted EBITDA margin of 20.7%. They told us, let me get rid of that. They told us 20 to 21%, so they came in line. 197 super scaled customers. I had 198 200. So they had one less super skilled customer than I expected. 1.8 million from that. 8 of the 10 verticals grew greater than 20%. Rule of 64 performance, 44%, 56%. I find nothing to complain about. So ARPU's at 1.8. That's pretty much in line with what, yeah. I guess maybe they wanted 1.9 to keep like the plus 300K, but no, 1.8 looks fine. That matches Q4, and Q2 is usually the second weakest quarter, and then you got Q3. What's up, Crux? I hope I said that right. This earnings looks fine so far, and we're down like 9% now. So we're doing like the normal pump and dump that we always do. That's like completely uncalled for. The longer our customers stay with us, yada yada. 3.9 million. And yeah, in 2024 that's 2.8 million. I don't know if that's any different than, oh no, these are still the full year 2025 numbers. Zeta 2028, did they raise guide? Tracking towards Zeta 2028, 2.3 billion, 573 million, 371 million. I can't tell if they, can someone tell me if they increased guide? It doesn't look like it on that. Third quarter guidance. So next quarter they're expecting 469 to 472 million. They're guiding for 39 to 40% growth. They have adjusted EBITDA of 115 to 116 million. I don't know, what did they do in their free cash flow? Free cash flow. What are their marigold? Did their marigold? Okay, so their marigold came in lower. So it did actually decline like they said. Okay. So that is honestly why I missed revenue, I think. Because I did their 55.6 million, which would have put me 7 million higher. And hold on. If I was 7 million higher, what was the headline number? Yeah, because they did 400. Hold on. Number should be total revenue. Yeah, so they did 443 million. That 7 million would have put them at 500 million. 450 million. I had like 452 million. So the main reason my numbers were off was because I didn't know what Marigold would do, which isn't even organic growth. So what was their organic growth? I want to know their core organic growth. Last time they didn't put their core organic growth though in the presentation. They put it in the investor note. So I might have to look in there. So 535 million. Okay. Second quarter 2026 expansion on the platform. Plus 90% free cash flow. So they're guiding for 255 million free cash flow, but what did they do this quarter? It has to be up, right? I had to skip it. Oh yeah, no. That's, oh, free cash flow on the gray. It's still full year target. free cash flow. Dude, these are full year numbers. They are guiding for 9 to 11 cents in GAAP EPS. Before it was 2 to 4 cents. So they increased that guidance. I'm skimming too much. That's my issue. I'm missing stuff. 2026 revenue new guidance, 1.18 million. Hold on. What did I put? It is actually crazy how insanely accurate my numbers have been so far. 1.8 to 1.83 billion was my guide. They matched my guide. And the only reason I was wrong on this quarter's revenue, pretty much I was wrong by like 2 million, is because of Marigold, in which I just put what they did in Q1 because I didn't know what to expect, and it's an acquisition. I had seen 1 quarter. I had 1 quarter to go off of, and I just assumed 0% growth. Okay. Stock is down 9% still. I would actually like, okay, for whoever's in here, I want to see how many people are in here. So who's ever in here, tell me why you think the stock is down. I want to hear people, like, raising this. I can't find one thing so far, everything. Okay, the revenue was slightly under, but are we going to say we were mad about Marigold? Like, are you kidding me? Like, that's like a joke. So, why do you think the stock is down? Because, and I don't want to hear it's because the stock's up. Because Palantir ripped 30% today. And you can say, yes, Palantir is growing 80%. But that's not the point. Because Palantir is also not a 5 billion market cap. And they're priced, their PEs, like their PEG, like yes, it deserves it. But the growth that we are going to see, let me find the organic growth number. I need to find that. I don't think it's in here. I think I have to go to the press release. But that's the only thing, but even then I know the organic growth is there because it's not Marigold, and I haven't seen political revenue, but you're telling me they did like 12, I don't even know what they'd have to do, like 20 million in political. They never do that. So this should be the 5th quarter in a row that they increased that, which for those in here, that's going to be a post here in a second. So you guys get like insider information of how I think. And you guys are real ones because you got Wealthmatica and Ronnie streaming, and you guys chose to be here. So I appreciate every single one of you guys. And if you guys weren't here earlier, we have a guest coming in. I don't know if you guys know him, but Joseph Invest will be joining us. So I like it because I want to create more community with the smaller accounts. I think that's important. Like we really have to grind for just everything. Like, I mean, I don't know about what you guys do, but we reply 300 to 500 times a day. I'm on this app probably 12 hours a day. Like, I know a bunch of other accounts do the same, so I want to, build that community up and just see where it goes. So we have Joseph joining us later, and he is also a Zeta holder for those who don't know him. And I'm going to try and find this organic growth. It's not in here. U.S. individuals providing permission, 240 million U.S. individuals providing, okay. And then there is a good chance that we can also make up a lot of gains once he starts talking about Palantir on the call. But, like, that shouldn't even have to be the case. Like, I almost feel like this sell-off is because they don't mention Palantir in their presentation. As stupid as it sounds, like, that's how dumb this market is. So, here we go. We have Delivered revenue of $443 million for the second quarter, an increase of 44% year over year, exceeding midpoint of guidance of $23 million or 5%. So there you go. They beat by 5%, that 2 to 5%. So that also debunks. You guys know him. I'm not doing this intentionally. But the bear who's known for, he does the rose thing. And he was arguing with me in July when the whole David stuff was going on. And he said that they couldn't actually do guidance. And that shows that he doesn't know his own business. They have stated many times they purposely put a 2 to 5% cushion. They beat by 5%. This proves he knows his business. So, you know, he's not going to see this. I don't care if he does see this. So if someone wants to send it to him, they can. But this proves right here and debunks this whole stupid argument. And I've seen him be bearish before. And at this point, similar to Paul Sierra with Hems, who's now a bull. So, and I'm not throwing shit at him. But he eventually realized, he literally could not be bearish anymore. Like, I don't care what he says. You sounded like an idiot arguing what you were arguing. Like, eventually this guy's going to realize the same thing. The arguments just don't make sense. And it's irritating because then they want to waste my time. And then, I don't know if I should just shut up and leave it alone. But at the same time, I don't want people to think I stopped responding because they won. So, anyways, off that route. They grew super scaled customer count to 197. I believe I had 198. An increase of 17% year over year, and super scaled customer ARPU grew to 1.8 million. That's up 17% year over year. Achieved positive GAAP net income of 8 million. I had 13 million. That is 3 cents of EPS, which I had 16. So I might have done the wrong share count then, or it might just be like a slight difference. I don't know. I might have done the wrong share count. Generated 92 million of adjusted EBITDA and expanded adjusted EBITDA by 100 basis points. Generated net cash provided by operating activity was 69 million, an increase of 65%. Free cash flow of 58 million. I had 54 million. They beat my number there, and I had someone asking me about my free cash flow number. They thought it was very bearish. I think this just locked in that my train of thought was somewhat accurate, but free cash flow is also hard because you don't know how the deals look when they're signing them. So you don't know how much upfront capital you're getting or how they're framed. Introducing an initial framework to measure adoption and monetization of Zeta's AI. So if we keep going, they should have organic in here. Last time it was near the bottom, I believe. Increasing revenue guidance of a range of 469 million to 472 million, up 10 million at the midpoint. Okay, so revenue guidance up by 10 million. Prior guidance was 461 million. Increasing adjusted EBITDA range of 150 million to 160 million, up 2.7 million at the midpoint. Of the prior guidance, that was 112.8 million. See, I know, the revised guidance represents year-over-year growth rate of 47 to 49%, just EBITDA margin of 24.4 to 24.7%. I know organic grew because I'm going to find this number, but I know it grew because they're revising guidance up, and they're only doing that if the core company is growing. Or I guess I didn't think about this. Maybe the market's mad because I think I figured it out. I think the market is mad because they're only increasing guide by 10 million in revenue, but they just announced the Palantir thing, which hasn't taken place in any quarters, and so they're expecting more revenue to be created from that, and so they're disappointed by the small revision up. That, I think, is what it is. That has to be it. That's the only thing. And that actually makes sense for how much we've run because of Palantir. But it still doesn't make sense in the fact that, okay, you have a company. Okay, let me stop talking. I'm gonna find this core growth because I don't care that it's growing 44%. I want to know what it is without Marigold and without political revenue. Full year 2026. Good. Zeta Live, about Zeta, forward-looking statements. The following. You know what? I don't find this in a second. I'm copying and pasting this, putting in Zeta. It's in here somewhere. I mean, not into Zeta. I'm putting it into ChatGPT and telling me it to tell me. Alright, Joseph just got back, so I think he's going to be joining us here in a second. If you guys found the core, let me know, but I'll have it in a second. Find me the core organic growth from this. Based on the earnings release you upload Q2 2026, core organic growth was 26%. Okay, did the math. Wait. No, yeah, it's like Q2 2026 core organic growth was 26%. Yeah, so that beat my estimate of 24%. Reported revenue growth 44% year over year. Management's product guidance excluded Marigold political candidate revenue. For Q3 and the full year, Zeta explicitly states Q3 2026 23 to 24% growth excluding M&A and political candidate revenue. So they're expecting 23 to 24%. Full year 2026 will be 24 to 25%. So yes, they did 26% in core growth, and we are mad. Hold on. Okay. I projected 24%. Many of the, I no longer care about what this report says, because core going forward is what's going to matter. So they got it 21%. I projected 24%. They did 26%. Now they're guiding for 23 to 24% in core growth. And so what? They're probably actually going to do 30-ish%. Like, this is what the market doesn't realize about Zeta, is they sandbag heck out of everything. Like, you have to take it report by report and just understand the trajectory and know where this is going. Like, I'm not mad at all. The stock is now $21.93. You know what? I am happy. I'm happy. This market wants to give me the dumbest discount ever. The dumbest discount ever. And you know what? I'm looking at this chart. I'm not a chart guy. But here you go. I do think charts align a lot of the time. That's what happened. You put this right there. Perfect. Perfect. You have a perfect downtrend. You have this wedge creating, and I've already had this downward wedge, so that's nothing new. You are probably going to get rejected, and eventually, whenever you break that out, that's probably when we're breaking out. I don't know when that is. Someone else in TA can tell me if I'm just an idiot, but I'm annoyed, but I'm buying. I have to buy more because you went from core organic growth without political revenue going from like 20%, and it continues to accelerate every quarter. I've given you guys my opinion. I've said I think they are on the verge of their Palantir moment, and every quarter, we see an urge for these companies to adopt them more and more. You've gone to 24%, now you're at 26%. They're guiding for 24%, but they are not doing 24% next quarter. They will beat that by the 2 to 5% that they state, and they will get it to like 28%, not counting political revenue. And we have midterms, so political revenue should be pretty decent. Let me fix my camera. So political revenue should be pretty decent. And whether people want to accept it or not, it's part of the business. So I've never really been a fan of excluding it, but it does help you understand like where the enterprise side is going. And I'm yapping, and this call should be starting. Hold on. Webcast. My thing's full. And
Reiner, Zeta's Chief Financial Officer. Before we begin, I'd like to remind everyone that statements made on this call, as well as in the presentation and earnings release, contain forward-looking statements regarding our financial outlook, business plans and objectives, and other future events and developments, including statements about the market potential of our products, potential competition, revenues of our products, and our goals and strategies. These statements are subject to risks and uncertainties that may cause actual results to differ materially from those projected. These risks and uncertainties include those described in the company's earnings release and other filings with the SEC and speak only as of today's date. In addition, our discussion today will include references to certain supplemental non-GAAP financial measures, which should be considered in addition to and not as a substitute for our GAAP results. We use these non-GAAP measures in managing our business and believe they provide useful information for our investors. Reconciliations of the non-GAAP measures to the corresponding GAAP measures, where appropriate, can be found in the earnings presentation available on our website, as well as our earnings release and other filings with the SEC. With that, I'll now turn the call over to David.
Thank you, Trey, and welcome to the team. We are very excited to have you. Good afternoon, everyone, and thank you for joining us today. I will start with the headline. We delivered our 20th consecutive beat and raise quarter, delivering the rule of 64 as a company and the rule of 49 excluding M&A. And in the second quarter, our year-over-year revenue growth accelerated to 44%, up from 35% in the second quarter of last year. This is the result of Zeta increasingly becoming the system of intelligence for our customers. The second quarter performance once again shows this strategy is working. Second quarter revenue was $443 million, representing year-over-year growth of 44%. That's up 28% year-over-year, excluding M&A revenue. Adjusted EBITDA was $92 million, up 56% year-over-year, with margin expanding 170 basis points year-over-year to 20.7%. And based upon this strength, we are once again raising the midpoint of our 2026 revenue guidance by $33 million. 20 consecutive beat and raise quarters reflects more than just strong execution. It is evidence of growing and durable demand for our platform that turns data into intelligence, intelligence into decisions, and decisions into measurable outcomes. Investors have historically viewed Zeta as a marketing technology company. Marketing is where our platform was first applied and where we built our leadership position. But that description no longer fully encapsulates who we are today. Zeta has evolved into an intelligent AI infrastructure platform. Marketing is our first application, not our limit. Our platform combines proprietary data, AI, workflow automation, and activation into a single operating system that helps enterprises make better real-time decisions and take action. The foundation is our data cloud, built on proprietary data covering more than 535 million individuals globally, trillions of signals, and 20 years of model tuning. And to be clear, this data is owned, not rented, because nothing you rent can be a moat around your business. Athena serves as the intelligence layer, allowing customers to interact with that foundation using natural language and embed AI directly into their everyday workflows. It truly allows customers to focus on outcomes versus navigating the platform. Our activation platform then turns those insights into actions across channels while continuously learning and getting smarter via the results. This has contributed to the strength of our net revenue retention. And with Zeta Business Intelligence, aka ZBI, we are also extending beyond helping enterprises to acquire, grow, and retain customers to a fourth use case, enabling organizations to transform business and customer data into intelligence, insights, and real-time actions. To be clear, this is not static dashboards or old-school business intelligence used to explain what happened. ZBI helps predict what happens next and acts on it in real time. A major sports and entertainment company uses ZBI today to understand its fans, share of entertainment spending, and engagement across live events and streaming. This helps quantify the value of current distribution partnerships, identify the most attractive future streaming relationships, and strengthen its negotiations at renewal. A leading energy drink brand uses ZBI to quantify the incremental value it drives for retail partners, including customer growth, spending, and long-term value. This helps demonstrate the brand's impact at retailers and identify opportunities to deepen distribution and partnership investment. Taken together, these capabilities position us as the intelligent AI infrastructure layer that sits at the center of enterprise decision-making. This transformation has been accelerated by 4 strategic catalysts. First is our OpenAI partnership. Our collaboration with OpenAI validates the AI strategy we have been building for years, enhances Athena's capabilities, and creates new commercial opportunities. As foundation models continue to improve and become more widely available, we believe the durable advantage will come from what's built around them: proprietary data, governance, workflows, and decisioning systems that turn intelligence into outcomes. Those decisioning systems are our own inference models, smaller, purpose-built models that we have been training on the data cloud since 2017. OpenAI powers Athena's voice. The decisions run on our models, and no large language models ever touch the data in our data cloud. The second is Athena. Launched earlier this year, Athena is fundamentally changing how customers interact with the Zeta platform. Athena is true voice enablement and fully conversational. Instead of navigating dashboards or conducting manual analysis, customers can simply ask for outcomes. The platform knows their business, decides, acts, and learns from every single result. That dramatically lowers the barrier to adoption and expands use across teams, channels, and use cases. We have seen that users who interact with Athena through voice exemplify this rapid adoption. Over the last 60 days, Athena's voice users are interacting with the platform at a 500% higher level than non-Athena users. We are also realizing the benefits of AI within Zeta. In the second quarter, 90% of our new code generated was automated, helping our teams to innovate faster and continuously enhance the platform for our customers. The third is Snowflake. We deepened our existing partnership with Snowflake, and we now have over 100 shared customers. reinforcing Zeta's role in the enterprise data ecosystem, where customers increasingly want to connect data environments with intelligence and activation. Zeta is uniquely positioned not only to help customers store and analyze data, but to act on it. And the fourth is Palantir. Our partnership with Palantir significantly expands Zeta's enterprise opportunity. Palantir provides the oncology, governance, and enterprise AI infrastructure that large organizations require. Zeta contributes proprietary customer intelligence, proprietary data, identity, decisioning, and activation. And we have reached two important milestones in this partnership already. Our data cloud was fully integrated with Foundry as of July 31st, and we have already received multiple agreements for our initial combined sale, with several other meaningful opportunities in flight. Together, these four catalysts are accelerating Zeta's transformation and strengthening our position as the intelligent AI infrastructure layer for the enterprise. We believe the defining characteristic of an infrastructure platform is not just innovative technology. It is a platform that becomes more valuable the more customers use it. Every decision it powers makes the next one better. And because those decisions run on our own inference models, not rented tokens, we make millions of them a day at infrastructure economics. That is the flywheel driving our results. And we're seeing it play out across our existing customer base. A leading telecommunications provider recently expanded its relationship with Zeta into real-time personalization, adding grow and retain use cases to its existing footprint. It is a powerful example of our land and expand model. Start with one use case, prove value, and expand across the customer lifecycle. Athena is beginning to accelerate that dynamic. To give investors greater visibility into its impact, Chris will provide more detail on our initial framework for measuring key metrics like revenue contribution, adoption, and usage later in this call. We'll continue to expand on our reporting around these metrics in the back half of this year. Gap is a powerful example of our platform evolution. As part of its broader AI-led transformation, Gap selected Zeta to help architect its next-generation marketing stack, with Athena at the center of how customer data, decisions, and execution come together. Our role extends well beyond powering individual campaigns. We are helping Gap to remove silos, unified decision-making across its iconic brands, and build a more intelligent marketing engine that learns, adapts, and acts in real time under a multi-year agreement as Gap's system of record. That is what it means for Zeta to become the transformation agent for the enterprise. This momentum was also evident at Cannes Lions, which served as an important proof point for the growing market interest in Zeta and Athena. We launched Athena for agencies, hosted more than 115 executive meetings, and delivered 37 live Athena demonstrations, resulting in a record sales pipeline coming out of the event. The conversations we began in Cannes will continue at Zeta Live, where we will provide an even deeper look at the future of Zeta and intelligent AI infrastructure. Zeta Live will be in New York City on October 8th. I'm excited to announce we already have two incredible headline speakers, Olympic gold medalist, entrepreneur, and founder Lindsey Vonn, and entrepreneur and global superstar Kevin Hart. Zeta Live has always been our opportunity to show customers, partners, and investors where we are going next. This year, we expect to introduce the next generation of Athena, continuing the extension of Athena as a super intelligent agent, answering questions and powering workflows to a system of intelligence that knows, decides, acts, and learns. The opportunity in front of us is no longer just about modernizing marketing. It's about helping enterprises turn fragmented data into intelligence, intelligence into decisions, and decisions into measurable growth and cost savings in their businesses. The past year has been an inflection point for Zeta, bringing together capabilities and investments we have been building for years. Yet, we are still in the very early stages of this opportunity. AI is changing how enterprises operate, how software is consumed, and what businesses expect from their technology platforms. For Zeta, that creates an opportunity to expand our role from helping customers execute marketing programs to becoming the intelligence layer that enables them to move faster, make smarter decisions, and drive better outcomes across the enterprise. We continue to be the disruptor in this new ecosystem. As always, I want to thank our customers, partners, and shareholders for their continued support. And to Team Zeta, thank you for your hard work, your commitment, and belief in what we are building together. Now let me turn it over to Chris to discuss our results in greater detail. Chris?
Thank you, David. I'll echo by welcoming Trey to the team. As we announced last week, Trey is perfectly suited to help lead Zeta's evolution into an intelligent AI infrastructure company. And I'm thrilled to see Matt Foss step up to lead FP&A for Zeta. In my conversations with investors, one thing is clear. A new framework for investing in companies is emerging. Investors are prioritizing their time with companies gaining share and delivering durable, predictable growth. They're increasingly screening for companies generating free cash flow and positive GAAP earnings. And they're ultimately backing companies with defensible AI moats proven by results. Zeta embodies each of these characteristics, and the second quarter's results make this evident. Q2 was our 21st straight quarter of greater than 20% revenue growth excluding M&A and political candidate revenue. Our increased second half revenue guidance continues that trend. Q2 was also our highest ever free cash flow, paired with positive GAAP net income, showcasing the quality of our earnings and driving the largest full-year guidance raise to free cash flow and GAAP EPS in our history. And we're listening to shareholders. We're introducing an initial framework to measure adoption and monetization of Zeta's AI, one underpinned by revenue, because moats are ultimately proven by how long customers stay and how much more they spend over time. I'll cover all of this in detail, along with updates on our pipeline, sales productivity, and drivers behind our increased Q3 and full-year guidance. Let's start first with the top line, where Q2 revenue came in at $443 million, up 44% year over year or 28% excluding M&A. That beat our guidance by $23 million or 5%, driven by faster growth in both super-scaled customer count and ARPU, each exceeding the growth rates in our 2028 model. Super-scaled customers grew to 197, up 17% year over year, more than double our 4 to 8% 2028 model growth rate driven by demand for Athena. Customer gains were especially strong in consumer and retail, telecom, and healthcare. Super-scaled quarterly ARPU expanded to $1.8 million, also up 17% year to year and above our 12 to 16% long-term 2028 model. And we're seeing some interesting usage dynamics unfold in ARPU. First, Athena engagement is increasingly voice first. 83% of customer interactions are now spoken, reinforcing our thesis that natural language will become the primary interface for marketing and business intelligence use cases and has the propensity to drive higher utilization on the platform. Second, the One Zeta sales initiative is gaining speed. Customers using more than one use cases are up 90% year over year. Customers using 5 or more channels are up more than 50% year over year. Cross-sell and upsell deals won in the quarter were up 43%. And we saw double-digit revenue growth across email, CTV, and social as well as double-digit revenue growth across all three marketing use cases: retain, grow, and acquire. And third, demand for the platform was broad-based across industries. 8 of our top 10 grew more than 20% year-over-year on a trailing 12-month basis, with consumer and retail, financial services, automotive, and healthcare all accelerating from last quarter. Also notable in the quarter was the significant expansion of the sales pipeline and strength in seller productivity. At the end of Q2, the total sales pipeline was up more than 60% year-over-year and up over $100 million compared to just 90 days ago. On a per-seller basis, pipeline creation is up more than 100% year-over-year as One Zeta and Marigold cross-selling take hold. This is driving higher average contract values on deals won in the quarter, up more than 40% compared to last year. And overall deal sizes in the pipeline increased more than 25% year-over-year, driven by higher attachment rates across channels and use cases, all while quota-carrying headcount increased by just 1 versus last quarter to 198, up 11% year-over-year. That gap between pipeline growth and headcount growth speaks to the strength of sales productivity. And importantly, this growth and revenue upside came with impressive operating leverage. Specifically, we generated $92 million of adjusted EBITDA, up 56% year-to-year at a margin of 20.7%, an increase of 170 basis points versus last year and $5 million better than the midpoint of our guidance. Marigold restructuring actions and integration savings drove total Zeta expense-to-revenue ratio efficiencies across R&D, G&A, and sales and marketing, improving 30, 180, and 250 basis points year-over-year, respectively. GAAP cost of revenue came in at 41% as expected. This was 10 basis points better sequentially and 300 basis points higher year-over-year, reflecting strong social channel adoption by agencies. Cash grew even faster than adjusted EBITDA in Q2. Net cash provided by operating activities was $69 million, up 65% year-over-year, with free cash flow of $58 million, up 73% year-over-year, a margin of 13.1%, and free cash flow conversion of 63%. We also generated positive GAAP net income in the second quarter of $8.2 million, compared to a net loss of $12.8 million in the same quarter last year, resulting in GAAP earnings per share of 3 cents. In the second quarter, we prioritized using cash to repurchase shares, deploying $29.9 million to buy back 1.6 million shares. And year-to-date, as of July 30th, we've spent $74.6 million on share repurchases with approximately $89.4 million remaining on our authorization. Dilution in the quarter was just 0.1%, and we remain on track to hit our normal course net dilution target of 3% to 4% for 2026. Finally, we closed a new $1 billion credit facility, including a $250 million term loan A and a $750 million revolving credit facility that remains undrawn, giving us the capital flexibility for M&A, share repurchases, and disciplined investment. To that end, we've been investing in AI for nearly a decade. So today's introduction of metrics showing how AI adoption drives deeper platform usage, longer customer relationships, and higher net revenue retention is not new. It's just more visible than ever. Super-scaled customer adoption of AI is ramping nicely. Since Athena's launch for enterprise customers 130 days ago, more than 40% of our super-scaled customers are already monthly active users, and together they've generated thousands of campaigns using Athena. And customers who comprehensively adopt our AI, using it for audience creation, activation, and other means, contribute a disproportionate share of revenue. It shows up in several ways. Across our total customer base, including pilots, proof of concepts, and scaled customers, the 20% of customers who have comprehensively adopted our AI tools account for roughly 70% of revenue. Among super-scaled customers, the 50% who have comprehensively adopted our AI tools drive 75% of super-scaled customer revenue. And these AI super users grew 4 times faster than the 80% of customers still early in their AI adoption journey. But it's not only AI adoption that's ramping. It's also leading to longer customer relationships. Super scaled customer relationships now average 56 months, up from 48 months a couple of years ago, and that's based on data going back to 2018. In addition to longer customer relationships, we're also seeing them spend more, generating higher net revenue retention among AI adopters. Customers who have most comprehensively adopted our AI tools have a year-to-date net revenue retention that is 400 basis points above overall Zeta, and more than 20 percentage points above customers still ramping in their adoption of our AI, showing that adoption is translating into stronger, more durable expansion. With tailwinds from AI adoption, higher sales productivity, and strong operating leverage, we're once again raising our top and bottom line guidance for the third quarter and full year. In doing so, we're maintaining our typical conservatism, building in a 2% to 5% cushion that assumes minimal go-get revenue from partnerships and uses 2028 model growth rates for customer and ARPU growth. To be clear, if new customer additions and ARPU growth exceed our 2028 model growth rates, driven by rapid Athena AI adoption or newly announced partnerships, that would push us towards the high end of that 2% to 5% range. For the full year 2026, we're increasing the midpoint of our revenue guidance by $33 million to $1.818 billion, representing growth of 39% or 25% year-over-year, excluding M&A and political candidate revenue. For the third quarter, we now expect revenue of $471 million at the midpoint, up $10 million from our prior guidance, representing growth of 40% or 23% excluding M&A and political candidate revenue. You'll note we're continuing to maintain our original second half guidance for political candidate revenue in Q3 and Q4 of $7 million and $8 million respectively. For adjusted EBITDA, we're increasing the midpoint of our 2026 guidance to $405 million, up $8 million from our prior guidance, representing a year-over-year increase of 45% and a margin of 22.3%, up 90 basis points year to year. For the third quarter, we now expect adjusted EBITDA of $115 million at the midpoint, up $3 million versus our previous guidance. We are also increasing the midpoint of our 2026 free cash flow guidance to $255 million, $20 million higher than our previous full year guidance, representing year-over-year growth of 55% and a margin of 14% and a conversion of 63%, tracking well towards our 2028 conversion target of 65%. Finally, we're raising our full year GAAP EPS guidance to a midpoint of 10 cents, well above our prior range of 2 to 4 cents. It's worth noting this guidance increase excludes the impact of a potential one-time tax benefit from the release of a valuation allowance that has a reasonable probability of occurring later this year, which could represent additional material one-time upside. With that, I'll close where I began. Demand for Zeta is robust and durable, and we're expanding our platform organically and through partnerships to accelerate share gains. That durable demand and record pipeline improves our visibility, giving us the confidence to raise guidance across the board. That visibility supports disciplined investment, and our balance sheet is well positioned to support our growth priorities. And focused execution drives greater profitability and cash generation, which has us pacing ahead of our long-term Zeta 2028 model. With that, I'll hand the call back to the operator so David and I can take your questions. Operator?
If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Again, press star 1 to ask a question. And our first question comes from Jason Kreyer with Craig-Hallum.
Great. Thank you, guys. Congratulations. Another great quarter. Chris, you talked about One Zeta and how that's accelerating the adoption of multiple use cases. I think you said 90% growth in multi-use case customers in the quarter. What do you think that looks like over the next several quarters? How does Athena continue to optimize customers and maximize both channels and use cases?
Great question, and thanks, Jason. The short answer is I think we've got continued runway because of One Zeta and the Marigold cross-selling, continued driving both multi-use case adoption, which, as you said, was up 90% year to year, but also 5 or more channel usage was up 50%, and cross-sell and upsell deals within the quarter itself was up 43%. If you look at the trend for ARPU growth over the last couple of quarters, it's been nicely above our 12 to 16% long-term model, and I see that continuing.
And we're seeing Athena really just the tip of the spear. It's just getting started. It's one of the single most powerful tools we've ever had for cross-selling against use cases and channels, Jason.
Maybe a follow-up for you, David. On the ZBI, can you just talk about how you go to market with existing customers? Like, what does that cross-sell conversation look like, and what are the key functions in ZBI that are really speaking to customers?
It's interesting because we've had customers that have been using the ZBI for a few months now before we announced it because we really wanted to get use cases in and tried it. So the use cases I gave in my prepared remarks are real-world use cases that they are paying us to develop and create with them. What we're seeing is that customers no longer want static business intelligence. They're not looking to have large numbers of people come in, put data into a user interface, spit out a static report. What they're looking for is how do they make real-time decisions? How do they better negotiate on contracts that they're in flux on, like broadcasting for sports networks? How do they figure out how to better invest marketing dollars and develop retail partnerships like with energy drink companies and so on and so forth? So we're actually getting pulled into the ZBI use cases more than we've been selling them in, and we're now sort of doing a combination of both together.
Jason and investors in the call, we've included slides in the earnings supplemental to David's point to bring those existing customer BI use cases to life. It's actually slides 32 through 38, and David mentioned there's dozens of customers spanning real estate intelligence, customer experience, market sizing, loyalty growth, business expansion, and business measurement, just to name a few.
Stock is way down 4%.
Thank you, guys.
If you find that your question has been answered, you may remove yourself from the queue by pressing star 2. We'll go next to Matt Swanson with RBC Capital Markets.
Great. Thank you so much. David, we talk a lot about that transition from, Zeta who to Zeta why to Zeta now. Can you just talk a little bit about when you get names like OpenAI and Palantir and Snowflake? It's probably about as good of a trio of partners in this day and age as you could find. How that helps you in your kind of go-to-market process of skip the evangelizing, but also what it can do for initial deal sizes.
Yeah, thanks, Matt. I would tell you that it has been game-changing for us. I mean, the 2 engagements that we signed with Palantir happened in real time. The Palantir guys walked us into 2 of the largest advertisers in the world, and literally we walked out with some of the largest test case and use cases we've ever had as a company based on the fact that they chose us to be their marketing platform partner. And if you listen to Alex's remarks yesterday, they are over-indexing on partnerships. One of the interesting things that I don't think people understand is that, the Palantir relationship will be one of the biggest we've ever done because there isn't a boardroom today that doesn't know who they are and isn't interested in use cases that they can do with them. With us as their marketing partner, it's become an incredible entry point. And if you look at the number of customers they published just yesterday, that is the number of marketing opportunities we effectively have in partnership with them. Add into that the OpenAI relationship, which has been one of the biggest we've ever signed, and the Snowflake evolution, we are seeing more at-bats than ever
if you saw the 17% growth in super scaled customer count, that's not even the beginning of what we're going to be doing with these new partnerships. In the evolution from Zeta Who to Zeta Now, these are game-changing even when we're not in the room with the Palantir, OpenAI, and Snowflake people. When we're out there, we're coming into meetings now, and the first thing I get is, wow, how did you get that deal done? And I have to say to them, which one? And we all laugh and sort of move on. But I think this is sort of, as they said in the movie Casablanca, the beginning of a beautiful friendship.
That's great. And then I think we touched on it a little bit when you were talking about the ZBI and the different uses for data. But when you talked about how your platform is just currently being utilized for marketing, but is not necessarily a marketing platform, how far do you think some of those adjacencies can go in terms of use cases? And have you seen within any of your larger customers any use cases that really have made you think about product development?
Yeah, well, every day we're getting asked questions by our largest clients. Can you help us fix this problem or answer this question in a way that we've never thought of? And it's causing just an incredible amount of excitement. I think it's important to note that if you look at the first quarter of this year, we were super proud to announce that using our internal workflow management tool, Spade, we were able to literally automate 75% of all new code generated. If you look at the update, the actual number for Q2 was 89.6%. I think we rounded it to 90 in my prepared remarks. But this is changing the game for how we take interaction with clients and turn it into product development almost in real time. And if you look at this very large sports league that is using us, we were looking and we were in the room with them and their CMO, and they're like, listen, how do we better negotiate our streaming rights with the two partnerships that are coming up for bid? And how can we equate viewership and mind share for they own multiple products, multiple leagues that are owned by one holding corporation. How do we help them to better show it's not just who's watching it in that moment, but it's the halo effect that comes for the broadcaster by having them on? And we were able to put together a solution in hours that came back and they believe will result in millions of dollars of incremental revenue to them on the renegotiation of those streaming contracts. So it then becomes a flywheel because then we get part of the marketing for those streaming rights. So it really becomes a major flywheel in and around the company, Matt.
Thank you.
And we'll go to our next question from DJ Hines with Canaccord.
Hey, thank you guys. Congrats on a nice quarter. David, maybe we can just follow up on the last point. I mean, ZBI and business intelligence is a massive category, right? I mean, you talk about getting pulled into this, and there's a lot of different directions you could take it. How do you think about formally productizing some of the use cases? How do you sequence which ones make sense first? Just high-level thoughts on kind of the multi-year playbook would be interesting as you think about building out that fourth use case.
Yeah, and obviously, as usual, great question, DJ. What we're seeing is that our data cloud is able to really help enterprises to make better decisions around certain things very, very quickly. We're seeing big examples inside of retail. What products should they be moving into retail? How do they use co-op dollars and marketing dollars to get better shelf space? And how to create deeper and more meaningful relationships with the end customer. So it starts with the business intelligence around a retail use case. You then end up identifying meaningful opportunities for them to move inventory around geographically, which retailers they should be doing more with, maybe which retailers they should invest less with. And then we end up being able to market to the end user to drive them into the retailer on behalf of the product and vice versa. So yes, we are seeing logical productization, much like we've talked about in the past, where, DJ, you've heard us say yes, our platform can help almost any vertical, but the more industry expertise our salespeople have across the 15 verticals that we operate in, the better they can sell, the higher the sales productivity per rep, and so on and so forth. We're seeing multiple use cases by vertical that we're building into the ZBI, and every new request from every customer becomes productized immediately, and that goes back to the ability to do 90% of your new code on an automatically generated basis. So it's really building a very interesting flywheel as we're growing the ZBI, not just from a revenue perspective, because by definition it's our fastest growing use case right now because it was starting from a smaller number, but the reality is it's becoming products every moment of every day that we're adding them in from a client question perspective.
Yeah, very clear. And Chris, maybe a more tactical question for you. Look, obviously we're heading into U.S. midterm cycle. I'm just curious what you're seeing in terms of political advertising demand, how much visibility you have there today, and kind of how that feeds into the guidance.
Well, from a guidance perspective, DJ, we've held to that consistent political candidate guide of $7 million in the third quarter and $8 million in the fourth quarter purposely because we wanted what to come through in the numbers was as the strength of the business unfolds in the actuals, the raise is all tied to the strength of the core business as well. The visibility is good in terms of we expect it to be very robust. It comes into the pipeline pretty late because these can be programs that spin up quickly and we execute even more quickly. We get paid ahead, which is nice, so it's good for free cash flow. But we're optimistic that the number we have in there is conservative. And we've got, for the full year guide, is maintaining our normal level of conservatism. So despite this being the largest raise of the year, $33 million in revenue, it still maintains our normal 2 to 5% cushion.
I think it's also important to note, we raised revenue by $33 million, we raised free cash flow by $20 million. So you're seeing a disproportionate percentage of incremental revenue into this business at this point drop to the bottom line. You saw 170 basis point increase in operating margin, and you saw a meaningful increase in free cash flow at 73% growth.
Yeah. Thank you, guys.
Thanks, DJ.
And we'll move next to Ron Josey with Citi.
Hi, this is Jake Halleck on for Ron. Congrats on the great quarter, and thanks for taking my questions. So my first is on the OpenAI partnership. So curious, how deeply is OpenAI integrated into Athena and Zeta's broader platform? Could you help us better understand the capabilities Zeta brings to OpenAI's ads ops? And is there a direct revenue opportunity associated with either side of that partnership?
Yeah, so that's a three big questions, Jay. But let's start with OpenAI powers the voice component of Athena. No large language models ever see the data in our data cloud or our client's data. We keep all of that totally and completely safe. And now the data cloud is built on Foundry with Palantir's ontology. So you're looking at a really interesting use case. What does OpenAI bring to Athena? It personalizes Athena, so now Athena gets to know the user at the enterprise better and can begin to understand what questions they have before they even ask them and help them better navigate to outcomes instead of having to navigate a platform the entire way. As it relates to the integration to their ad platform, we are actively serving ads, and it is a meaningful revenue opportunity. It is also scaling very, very quickly. I think it's also, as Chris pointed out, part of the conservatism we've put in going into the year, where we really haven't included pretty much anything from either Palantir or OpenAI as it relates to our forward guidance. And, next week we have a follow-up meeting with OpenAI. We've got 20 people in a room literally brainstorming what else can we do together. I think they consider us one of their most important enterprise partnerships, and we certainly look at them in the same way.
Thanks. That's so helpful. And I know it's a three-parter, but can I just sneak in one more here? You did appreciate the update on the 90% of new code generated through AI and Athena operating largely on in-house inference. Could you just touch on how those capabilities and that AI code is changing your product development speed?
It's just, accelerating it at a pace that I never thought humanly possible, Jay. When you look at the fact that, yes, we increased operating margin by 170 basis points, we added engineers in the quarter. We did not eliminate engineers in the quarter. So the fact that we're even able to add horsepower to that while simultaneously having 90% of all new code being auto-generated is pushing pushing development cycles, I should say, to what would have been years at one point to what is now months, and new products inside of the ZBI as we productize it to hours versus what could have been months in the past. I think when we get to Zeta Live on October 8th, we're going to have a massive unveiling that I'm incredibly excited about. That's a product offering that will continue to evolve Zeta as a company in a very meaningful way. And it's something that would have taken years that we're now going to be able to have done in months.
Thanks a lot, David. Appreciate the color.
And our next question comes from Elizabeth Porter with Morgan Stanley.
Great. Thank you so much. So I just want to do another follow-up on ZBI and how that's changing some of the market opportunity. We used to talk about Zeta having 1% of the marketing wallet, but an opportunity to be closer to 10%. Just as you're going kind of beyond marketing to the broader business intelligence, how should we think about the wallet share that's up for grabs and how that changes with ZBI? And just as a follow-up, how should we think about the sales cycles as you expand from more of a CMO-focused product to just broader touch points across the organization?
Elizabeth, let me start by saying welcome back. We've missed you.
Thank you.
You're welcome. From a ZBI perspective, I want to be clear, we're still looking to get to 7 to 10% of our clients' marketing wallet share. That's not changing. We believe that we are on our path to building a $10 billion business with a 30% operating margin, with the vast majority of that dropping to free cash flow on the marketing component of our business alone. When you look at the ZBI and the opportunity that it's opening, what we're seeing, and what really happened, Elizabeth, is we started getting pulled in that direction by our clients at first. That then accelerated massively with the Palantir partnership, whereby putting our data cloud on top of Foundry and the ability to onboard seamlessly our clients' data in ways that we couldn't before, and using their ontology in a way that we couldn't have done without Palantir as a partner, that's opened up this entire new use case from a productization perspective. I think we're going to look at two different sales cycles. I think we're going to have existing clients that are going to adapt or adopt the ZBI very quickly. Then I think we're going to have new clients that we're going to go out and get, where you're going to start with the CIO or the CTO, and that could take a little longer. As you know, our normal product cycle is anywhere from 90 to 180 days. I think this will be very, maybe start out on the longer end of that for new customers, but we'll start on the shorter end of that for existing customers. And quite frankly, we've seen much, much faster than that from an adoption perspective from existing customers who are adding ZBI as their third or fourth use case. Does that make sense?
That does. Thank you very much. And I wanted to do a quick follow-up on Athena for agencies. It sounds like you had a lot of high interest in France this summer. So when we think about the base of agencies, is there a certain proportion that's a good client base for Athena for agencies? Is there any sort of specific subsegment? Or do you think that most agencies could adopt Athena over time? And what are you learning about the onboarding cycle that could potentially drive some faster penetration?
So to answer your question, I was shocked because I thought it would really start at the mid-size agencies from an entry point perspective. We're actually seeing the larger agencies adopt it faster and at scale very, very quickly. It really changes the game for them from a navigation perspective and the ability to showcase for their customers our data cloud and the ability to drive substantially higher return on marketing spend. As you know, Elizabeth, we always talk about we deliver, according to Forrester, 600 to 700% return on marketing spend. We're seeing clients who are adopting Athena at substantially higher rates than that. In partnership with a very large agency that adopted Athena and a very large airline, we're seeing that airline today at a 1,400% return on marketing spend, post the agency bringing Athena in and us putting together the project together. So I actually thought it would be small to mid-size. It's starting very, very large, and it's scaling, quite frankly, a little faster than we expected.
Great. Thank you.
And we'll move next to Arjun Bhatia with William Blair.
Perfect. Thank you, and I'll add my congrats on a great quarter. David, I'm going to start with you just on Palantir. It sounds like, obviously, you did the tech migration and you're on board on Palantir, but it also sounded like you're closing some deals already on the cross-sell. So would be curious to hear just what that pipeline looks like into Palantir's commercial customers. And, just as you look across different verticals, are there any inside that commercial base that get you more excited than others from an opportunity perspective?
Yeah, I'll be honest. I publicly said that I plan on doing the first 20 deals in partnership with Elias Davis, who's become a very good friend of mine, who's one of the top guys at Palantir, reports directly into Alex's office. And we've been going out, and I would tell you that if I put the numbers of the deals we're working to into our pipeline, it would artificially skew our pipeline up too much at this point. It is that big an opportunity. So I'm sort of working on it on an internal pipeline that I'm running in my own office at this point. I'm embarrassed to say I'm doing it inside of Claude. But the reality is that this is maybe the biggest opportunity we've ever had in front of us, certainly the biggest opportunity we've ever had from a partnership perspective. And as you know, we have 15 different verticals that we operate against. Not one of them is a massive concentration. So when I look at their client base, I started by saying, why don't we just start with the 20 customers who spend $1 billion a year on marketing to consumers? And the list was so much longer than 20, we had to pare it back to start going out there and getting into it. The two deals we closed were at 100% hit rate. Met with 2, closed 2. We've got some other very large ones in flight, and we see this as a meaningful and very large opportunity that, as Chris said, is not baked into the numbers just yet.
All right. That's great to hear. And then, Chris, maybe one for you, or I guess maybe for David also, but would love to hear sort of your updated thoughts on capital deployment with the new credit facility. And, I think you pointed out M&A as obviously a potential use case, which you've been sort of consistent on, but I'm curious if there's any sort of change in the type of acquisitions or assets you're looking at in the market.
Chris pointed to me, so I'll answer it. What I would tell you is we are going to continue to focus on our 5 pillars of M&A. That is not going to change, although you can look at the fact that for us at this point, we have to continue to evolve the type of deals we've done or will do because, some of the smaller deals we've done over the years just wouldn't move the needle for us at this point. I will tell you, Arjun, you've heard me say this many times over years, I believe transformative M&A transforms both companies for the worse. So we are not looking to go do one huge transformative deal. We will continue to do small to mid-sized deals where we're adding great human capital, great data sources, incredible products that our clients want to buy, and clients that want to buy our products, and so on and so forth. This does give us optionality around the buyback. It could cause us to accelerate it in the short run, depending on how the stock trades. But the reality is it puts us in a position that we have a lot of flexibility as a company. I mean, you can see the cash position is also very, very strong at the close of the quarter. And we're projecting, I'm pretty sure this will be a record free cash flow quarter for us, right? Yeah. So, you know, we last quarter, you can do the math, we bought more than 50%, I think closer to 75+% of our free cash flow and share repurchasing last quarter. We're going to continue to buy the stock back at these prices because we think we continue to be the best investment we can make with our free cash flow is purchasing back our existing shares.
All right. Very helpful. Appreciate the call. Thank you.
And we'll move next to Callie Valente with Goldman Sachs.
Hey, team. Thank you so much for taking the question. So new AI products have generally taken a while to ramp in usage for many software companies. Are there a couple key things you would point out that you think have made your customers adopt new AI tools faster than what we're seeing in the rest of the market?
First of all, Kelly, congratulations. Callie, I'm sorry. Congratulations. We're super happy to have you covering us. Return on investment. I think one of the things you see in our business strategy is our ability to show a return on investment is second to none. Most AI products where you're making a large investment into whether it's infrastructure, software, or technology take years for enterprises to show return on investment. Our 4 use cases show massive return on investment. As we've talked about, our marketing use cases show a 600 to 700% return on marketing spend effectively day one. And if you look at the ZBI, we can't quantify it just yet, but we're giving real-time business decisioning that drives massive incremental profits into our clients in real time. So I think that's been one of the big differentiators for us versus companies that are out there selling, very expensive technology that will take years to pay off.
Yeah, that makes a lot of sense. Thank you. And then just one more from me. We're hearing more companies talk about headless architectures as agentic kind of potentially disrupts the UI or traditional UI. How do you think about this in the context of Zeta? Like what makes sense for you? What wouldn't make sense for you?
I mean, listen, we've been no code for many years around here. So when you look at what they're talking about as it relates to headless, that's not something that I think we end up dealing with on either side. I don't think it becomes a competitive force for us, and I don't think it's something that we would move into quickly from our front. What we're really focused on is what percentage of our new code can we generate and make generally available to our clients. And we've gone from what was 75% to 90% in the first quarter of this year to the second quarter of this year. That puts us in a massive competitive advantage. As our competitors are trying to catch up to where we were a year, 2 years ago, we're already moving to where they won't be able to get for many, many years. And I think our no-code architecture has allowed us to do that.
Awesome. Thank you so much.
And we'll take our next question from Terry Tillman with Truist Securities.
Hi, this is Luke Radice on for Terry. Thanks for taking my questions. To start, considering the big strategic win with Gap, how is RFP activity? And what are you seeing in terms of large MarTech replacement cycles, potentially aiding revenue and business in the second half or helping enhance visibility into 2027?
Hey, thanks for the question. Just real quick, RFP activity is very strong. You heard about the pipeline stats that we shared. That's built into the greater than 60% year-over-year pipeline growth. I think it also speaks to how the average contract value in the pipeline is up because more of it is RFPs. I'll turn it quickly to David to talk about broadly what's driving that environment.
Yeah, I mean, we are right in the middle of what looks to be a marketing cloud replacement cycle. And Gap was a perfect example. Gap had been with one vendor, Salesforce, for quite some time. There were 3 other vendors that we displaced in addition to Salesforce to become the system of record inside of Gap. And when you look at these very large organizations, they don't want to use 4, 5, 6 different vendors, including a software provider, a professional services firm, activation platforms, data, CDP, all separate. These very large enterprises want next generation technology. And today, we are the only marketing cloud that has data and AI as native foundational to the application layer. So as other entities have to step out of their platform through API integration to use AI and then to get to the data sources and then back to the AI and then back to the platform, that latency destroys return on marketing spend. Our foundational platform can answer in a millisecond what other platforms can't answer at all, to be quite frank. So we're actually seeing RFP velocity go up, and we're seeing closing go up as we saw in this quarter. And we have a record pipeline right now. It's by far the largest we've ever had. So I think we're very well positioned for where the market is and where it's going.
Great to hear. And if I could sneak one more in, given the increased adoption with Athena and AI-enabled workflows, could you help us think about the puts and takes on gross margin performance in the back half of 2026? Thank you.
The gross margin performance in the back half of the year is largely dependent upon mix. So we talked about how the second quarter came in where we expected, given where the direct mix was in the quarter of 72%. Where that efficiency plays in, by the way, not just in R&D, but also across G&A and in sales and marketing as well, is we saw in the second quarter, and we expect to continue to see very strong unit economics on our expense to revenue ratios. That showed up in very strong adjusted EBITDA margin. We're continuing to see efficiencies in CapEx, which then obviously flowed through the higher free cash flow. And then the good work on dilution and on stock-based compensation generated the very positive GAAP net income.
Awesome. Great to hear. Thank you.
And we'll go next to Jack Nichols with KeyBanc Capital Markets.
Hey, guys. Thank you for taking the question. David, maybe to start with you, how are you thinking about the opportunity for Athena's heavy users today, post-Foundry infrastructure pivot? And what does that mean for these heavy users on the new platform? And what's the biggest risk in the coming months during the transition with the move to Foundry?
Well, so to be clear, the transition's done. It's seamless to our clients. We re-architected the data cloud on top of it and adopted their ontology. So it is a massive benefit to answer your question. So when you look at Athena, at the top of our tech stack is now going to be Athena powered by OpenAI. She will then interact with the Zeta platform in addition to the data cloud. Every time the Zeta platform and the data cloud access data, it'll now be inside of Palantir's architecture, which moves extremely faster than the architecture we were working on before. So we'll be able to answer more questions smarter and faster. We'll be able to onboard new client data faster and with better orientation, which will allow for higher levels of intelligence faster. As you know, the longer a client has worked with us traditionally, the smarter the platform has gotten, the faster the return on investment. With Athena and Foundry, we're seeing that happen faster. Instead of taking years of managing questions, it can now take days to get to the same level of return on marketing spend and the same intelligence that used to take us years. And that, I think, is going to drive much faster adoption. And once again, heavy users had a 400 basis point higher net retention rate than our other clients for Athena today. I think you're going to see that number continue to evolve.
That makes a ton of sense. Thank you. And maybe for Chris, what kind of usage trends of Athena are baked into the super scaled ARPU growth to achieve the organic guide?
What we have line of sight to. So, and that, by the way, same is said for the partnership agreements. We talk about the multiple layers of conservatism. What we built into guidance is what we signed already. So we're not leaning into anything on a go-get perspective on either AI adoption or newly signed partner agreements that are still yet to be closed in the pipeline.
Awesome. Thank you.
And up next is Matt Bullock with Bank of America.
Great, thanks. Appreciate you taking the question. I was hoping you could maybe put a finer point on what's working well in terms of driving improvements in sales rep productivity. And then can you help us think about the outlook for quota-carrying rep headcount for the remainder of the year to address the pipeline you talked about? Thank you.
Yeah. So first off, One Zeta continues to be gaining speed. So we launched One Zeta, call it 15-ish plus months ago, and we're starting to really see the benefit of our sellers attach more channels and more meaningfully more use cases into their deals. We talk about pipeline creation per rep being up around 100%. That's a big source of it. Also, we're called 6 months now from acquiring Marigold. All the hard work on the integration has been done both within the G&A sales, marketing, R&D structure. Now we're starting to see the benefits of the cross-sell and the upsell activity, namely really around their loyalty products and selling Zeta's acquire and grow use cases in. So I feel like, we're at a place where we've got the right tenure of reps, meaning the right balance between those who are in their first 12 months, 12 to 24 months, and greater than 24 months, where the type of productivity we're seeing now can really continue to go throughout the year.
I also think our hyper-focusing by vertical, by salesperson, has really unlocked a massive opportunity. That was sort of an aha moment for us, Matt, where we start to see when we bring in people who have industry expertise in a vertical and they sell, their productivity goes through the roof.
Got it. Thank you very much.
And we'll go next to Richard Baldry with Roth Capital Partners.
Thanks. You talk about in the generative engine optimization side, do you think that's helping you win client wallet share, or is those dollars really sort of moving from one channel to another?
Because we never did search engine optimization, it's 100% upside to us, Rich. So the other thing we're finding is that new clients are really excited about that. And we're one of the very few companies that has an API integration into Claude, ChatGPT, and Gemini. So we're able to help across all of those platforms in real time through one GEO user interface. And then we're able to serve the marketing, obviously, into Gemini and into OpenAI as a subset of that. So you're able to really move the flywheel in a way that I don't think others are able to do. I think new customers see that as a, quote, shiny new thing and think it's very exciting. And we're seeing existing customers adopt it as a part of their marketing strategy.
And actually, maybe if you think about how fast-moving those generative engine corporations are that you're partnering with, and Palantir, itself is a different use case, how fast that company is moving. You've really grown without adding a lot of headcount in recent years. Do you think there's a point at which to try to keep up to those opportunities, you need to, add a bit more to the headcount to support the fast growth in those areas?
We're just not seeing that right now, Rich. We're seeing productivity in the company go up at a rate that I didn't think possible. Not only are we seeing, as I said, 89.6, call it 90% of our new code generated. We did a really interesting deal this quarter where we signed one of the first sort of ubiquitous enterprise agreements with OpenAI, where all of our global employees now have access to all of OpenAI's products. And not only are we doing that, we're doing it in a way where the use cost for everybody is baked in. So we've got a use cost for everybody. If power users go over a certain amount of token usage, the platform actually refers to their manager to approve additional token utilization. I think as we're building productivity tools like that, we're seeing sales productivity explode. At the same time, we're seeing total AI cost for the company internally well under 1% of revenue, and we think that's something that's going to continue. So I spend a lot of time on this, as you know. I mean, I think we'll add headcount, but I think we'll add headcount at a slower pace than we grow revenue, and we'll continue to grow EBITDA and free cash flow at a much faster rate than we're growing revenue, if that makes sense.
Yeah, David's exactly right. We've actually added headcount, just grown revenue much faster. And even though that AI-based usage is up across the company, unit costs for that AI are down almost 40%.
And that's because of the relationships we've been able to negotiate.
Congrats on a great quarter.
Thanks, Rich. Once again, I'm so proud of the team.
And we'll move next to Scott Berg with Needham.
Hi, everyone. Nice quarter. I'll skip the 17 Palantir questions, move to something a little different, I guess.
You're kidding, Scott. You don't want to talk about Palantir?
I do. We'll speak on it plenty coming up pretty soon, I'm sure, David. But my question's on your expansion opportunity, especially within your super scaled customers. You know, the slide in your deck, in your presentation deck in the quarter, I thought was kind of interesting that you've been kind of range bound on the ARPU for your super scaled customers over the last 7 quarters. It's kind of bounced around from 1.6 million to 1.8, just kind of back and forth. We know you guys are doing a good job of expanding with some of your customers. I'm trying to just trying to better understand that dynamic, I guess. Are some of your new customers maybe coming in with a slightly lower ARPU on that super scaled level to just kind of balance that out, or maybe the metrics not reflecting some, maybe numbers or some expansion deals that we're maybe expecting in the back half of the year?
It's more the latter, and I'll go quick just so we can get other questions in, but there's a slide 8 in our earnings supplemental. What's masking that, Scott, is that as new pilots and proof of concepts become super scaled, so they cross that 1 million threshold, they are still a distance from where our more mature, those super scaled customers that have been on the platform, call it 2, 3, 4 years, that have a ARPU that is 4, 5, 6 times greater than those that are in their kind of early part of the journey. So what you'll see on the slide is the average size in terms of ARPU of a customer who's been on the platform less than 12 months is $700K, as opposed to those that have been on the platform 4 more years, that's now approaching $4 million per. So we're actually seeing those super scaled customers get bigger, become a bigger and bigger part of our overall revenue, and have a greater and greater share of our net revenue retention.
Thanks for taking the question. I'll jump in the queue.
And we'll go next to Clark Wright with D.A. Davidson.
Awesome. Thank you. It was great to see better than expected organic growth results this quarter. How much of this growth is coming from continued success with agencies versus your direct enterprise sales motion?
I think it's really well spread out, Clark. We continue to see the agency business at approximately 20% of revenue, and we continue to see direct to enterprise at approximately 80% of revenue. So we haven't seen that skew meaningfully, but we're seeing meaningful organic growth across both those components.
Awesome. Helpful. And then there was a sequential step down in direct platform revenue from 75 to 72%. What caused that this quarter, and is that something we should expect going forward to be at that level?
I was just about to add to David's answer. What drove that was new sales and expansions with agencies. In fact, just within this quarter, since we closed and within the timing of this earnings call, we closed and expanded with another very large holdco. And as you probably know, Clark, those newer agency signings tend to begin with social. And social is a channel grew very rapidly in the quarter again, and drove the integrated platform revenue mix to be higher, and then as a byproduct of that, the direct platform mix to be at 72%. But it was where we expected based upon how we saw the pipeline, but it's driven by very strong agency adoption of social as the initial channel.
Got it. Thank you.
And we'll go next to Naved Khan with B. Riley Securities. Your line is open.
Hi there. This is Ethan Wydell calling in for Naved. Thanks for taking my questions. To start, it's great to see that you've had really strong uptake of Athena since making it generally available, but it sounds kind of like the costs haven't scaled at the same pace as usage. As usage does continue to scale, how should we maybe think about the way that cost scales or token costs pass directly on to customers, or does usage become a cost of revenue consideration?
No, so I would tell you that we've done an agreement with OpenAI where we have a tremendous amount of visibility into our cost, and in this particular product, it's not focused on token utilization. So it's focused on a sort of a license for the product that is fully embedded into Athena. I feel very comfortable that we will be able to continue to keep our total AI cost well under 1% of our revenue, while simultaneously growing revenues at obviously substantially faster paces than that, Ethan.
Understood. That's really helpful to hear. And then separately, so 8 of your top 10 industries grew over 20%. Can you maybe speak to how those areas are pacing so far in June and July?
I don't want to get, first of all, the performance within our quarter in 2Q was pretty linear, and I would expect third quarter to be the same way. I don't want to get into projecting third quarter, but what I can tell you is the momentum that they have. We talked about within 8 of the 10, and by the way, one of those 2 that didn't grow over 20 was advocacy, and that obviously has a lot of tailwinds going into the second half of the year, so I'd expect that to be one of those greater than 20s next quarter. But there were several of our industries that actually accelerated in their growth from a trailing 12-month basis ending the first quarter to where we ended in June. Those were consumer retail, financial services, automotive, and healthcare, all industries with, obviously a lot of marketing spend behind them.
Obviously, we wouldn't have raised the quarter by $10 million if we didn't think we had a lot of visibility into the quarter, Ethan. So as Chris said, we don't want to comment on 1 month, but nothing that happened in July would lead us to believe that we shouldn't have raised the quarter in the year as much as we did, or we would not have done that, if that makes sense.
Understood. Yeah, that's really helpful. Thank you for the color, and congrats on the strong results.
Thank you so much.
And that concludes our Q&A session today. I'll turn the conference back to David Steinberg for closing remarks.
I just wanted to close on how incredibly proud I am of the Zeta team to be able to continue to execute 20 for 20 quarters as a public company, 20 quarters beating and raising, to continue to execute over that period of time with that level of excellence, to continue to see accelerated sales growth, to be able to do partnerships with 3 of the world's most important companies within just a few months. If you had told me a few years ago that we would be in a position to announce partnerships like OpenAI, Palantir, and Snowflake, I would have been blown away by that alone. That shows what's happened to Zeta as a brand, because none of them would have trusted us if they didn't trust our brand and they didn't trust our business. So thank you again to all of our Zeta people, to all of our clients, and especially to our partners. We appreciate everything that you guys are doing for us and with us as a company. Have a nice day, everybody.
And that concludes today's call. Thank you for your participation. You may now disconnect.
So, anyone think those closing remarks kind of seem targeted at the whole David Steinberg isn't a trustworthy person? Because the whole argument about that was everyone was pointing to this. I pointed towards it. I said, you think Palantir is going to partner or associate themselves with David Steinberg if the business isn't serious? Or if they can't trust the brand, can't trust the CEO? No. And that's exactly what the closing remark was about. So perfect. But I made a few notes. There was like one thing. I don't know. Like, you guys can comment if you guys caught onto it. But it said something about net retention rate. I missed it. My dog was distracting me. He got upstairs. Someone let him up. I heard him running around. And yeah, I didn't catch it. So I was curious about that, if anyone caught it. I didn't know if they said anything about it increasing, because I think on the slide it just says 120% full year. I don't believe it's for the exact quarter. I can look real quick. Problem is I have to find exactly where it is, and going through this long thing is annoying. I'm almost there. Yeah, it says 120%. I guess it doesn't exactly say the month for the retention rate. All it says is it's in the band of 115 to 125%. So that's the midpoint. Zeta's net retention rate is 120%, which is matching Datadog, and it's better than CrowdStrike, worse than MongoDB, worse than Snowflake, and worse than Palantir. But Snowflake's is like 125, Palantir's is 139, so they're all around the same ballpark. But I'd expect that to continue growing as they expand use cases. And so some of the things I want to talk about. So they officially are on Foundry. You guys might have seen my tweet on that already. They're officially built on Foundry. They're now negotiating contracts in which David Steinberg is going to do the first 20 of them. He said he met with 2 and closed 2. But he also said something about, like, if they aren't already working with Zeta, we could expect them to take 90 to 180 days, I believe is the time frame he gave. So as far as like getting new Palantir customers who might not be with Zeta, that's going to take a bit more time, and we'll see that it could be boost to Q1 of 2027. Q1s are usually weaker quarters, but maybe we get another great Q1 print like we did this year, because we see some new clients who don't use Zeta at all coming and, you know, immediately just getting engulfed into the ecosystem. So yeah, so I'm assuming those 2 new clients, they're 2 clients that were already using Zeta. And then he also pointed out, so in the past he pointed out that they had a customer seeing 1400% ROI. And in this, he confirmed that that customer is a airline. So I'm actually going to, after this, I'm going to see if I can figure out what airline that would be. I don't know how public, you know, they've made all their airline partners in the past. So I need to figure out, you know, which ones possibly actually work with them, and go through that, and go through even maybe some earnings. Maybe some are talk about actually using AI, and that's brought down their marketing costs, and which maybe their net income's doing well. This is just going to be a string of things, but I'm going to try and bring that to you guys. It'll probably be both tomorrow. See if I can figure that out. And then they're adding headcount. I thought that was interesting, because before the Palantir partnership and before they really even started talking about business intelligence, I remembered them talking about decreasing headcount, and, you know, like the utilization of AI. They talked about their relationship with OpenAI in the past, and that token costs weren't an issue for them, and that it will actually lead to a reduction of headcount. Well, now I think it's pretty simple with the building themselves on top of Palantir and onboarding more customers, and also getting into business intelligence now, and really just becoming more than just a MarTech and focusing on marketing. They're increasing headcount not because AI is playing less of a role. He mentioned it's playing an even more of a role, but there's so much building going inside the business that headcount is increasing, but it's increasing for now. It's not going to increase forever. I expect this to plateau. It's going to begin to decrease as further integration happens. So I don't think anyone's worried about headcount going up. I could really care less, as long as it's not hurting the income statement, and it's not. And then he mentions they continue to see buying the stock as one of the best investments. And back when it was $15, after Q4, he had said that in Q4, it was the Q4 earnings call, I believe. He would call the stock a BOGO, and that's when it was about $15. Now we trade at $22 after this report, which is up a decent amount, but they've grown 50%, now 44%. They raised guidance. Valuation-wise, I don't think it's much different. I'm sure he still looks at the stock pretty similar. They bought some shares back to limit the dilution, but this stock is going to be, in the future, a buyback machine, and that is why I don't ever plan on getting rid of this one, especially when it trades at a valuation so cheap. Like, its valuation so insanely cheap. You see these other, I mean, you look at a ServiceNow, people talk about how cheap ServiceNow is, and I'd have to look real quick, but they trade, okay, I can't look at it there. I don't know what their PE ratio is off the top of my head. Their PE ratio is can't find it. I know what people argue. People argue it should trade at a 40 to 50, and I get it, the margins of a bit of just SaaS businesses in general. But the free cash flow that the operating free cash flow that Zeta trades on, just how quickly they're gonna scale EPS. I mean, this thing's cheap. This thing's cheap, and as long as it's this cheap, keep buying back shares, and if it's always this cheap, then I could care less. Like, how much are you going to punish a business whose margins, it's going to be, if I take a guess, probably like 50%. I mean, what are they telling us right now? I'm pretty sure they've said in the past, unless if I'm mixing it with SoFi, but I honestly think they both said that they are going for margins of like 30%. Let me scroll up. Where is this? I don't see them talking about margins. I mean, the adjusted EBITDA margin is going for 22% for 2026. And they're going for 25% by 2028. I mean, these are only going to keep expanding. Like, the moment, like, once they're, like, not investing into the business so much, and which they're going to for a while, but I hold these businesses to maturity. So I'm trying to think, what could these margins look like when the business is mature, is what I'm thinking about. And my point is, they're going to generate so much free cash flow that they're just going to be buyback and dividend machines, but I assume they're going to lean heavier into buybacks than they would dividends in the future. And who knows, maybe they continue finding ways to expand the business, because, I used to say, this business has so much potential, I don't know why he would always give a maturity goal of 10 billion. I would say that. I said it didn't make sense. I can pull up old posts. I was like, it doesn't make sense. I was like, there has to be more to it. And then they announced business intelligence, and now that's the whole new growth lever. And I always thought of them as a business intelligence platform, like, naturally, because, when you have a company that can return so much ROI based off knowing what customers want to see, that's going to result in revenue and profits at the end of the day, that in a way is already business intelligence. But when you have so much data and you can synthesize that for an enterprise It makes things so much more simpler. So now you're in business intelligence and marketing, and it's like, what could that third pillar be? I'm not sure yet. I really have to give it thought. But there's just so many use cases with the data moat they have. So yeah, and I do want to hear, actually, they haven't talked about this. Maybe this is a third growth thing. Right now they're mainly in America. So I know they want to expand further into Europe, but we've not gotten much word about that. I want to know how they plan on doing that expansion. How do they plan on getting more global identity? So more identity just inside the U.S., and then begin to expand into other areas or other regional areas. That, I would guess, would be the next growth component, because when you think of the global market, for just marketing alone, it's $1 trillion. So that doesn't even include then the business intelligence of, like, I think this just gets so good that you can get all the business's back-end data, get it synthesized for you inside machine learning, and just feed you answers. Then you only need 1 to 2 people high up giving the go. It's like when you have these teams who are told to work on a project, they come to management and say, this is what we're going to do, and they're like, yeah, that's cool, whatever, and you give the reasoning. Soon it's going to be, you give the AI all that information, it's going to give you a response, and they're going to give it the go-ahead, or be like, or tell it why we're not going to do that, and come up with a new solution, and then it will. And I've always said it's going to replace so much headcount on projects, but productivity will increase so much that it's going to still create more jobs and new jobs. I don't think it's like this whole unemployment scare people talk about. So I'm excited for what they're doing. I'm annoyed with the stock, of course, as we are currently trading at $22.47. The stock made a little bit of a comeback. Looking at it though, like, you're still, if you take today out, so you take the Palantir move out, and you just go off of yesterday, it's like we closed slightly down since yesterday, and I'm not really gonna complain over that. We've been on a tear. I think it's healthy. I've said in the past that I wanted to see our next move have structure, and that's what this pullback's getting. And I'm not gonna promise you, because nothing I say is financial advice, but I would bet a good amount of money, and maybe I do, just depending on where we are at in the morning, just buy a weekly call and just say, screw it, I'm gonna gamble a little bit. But I bet you this dip gets bought, because there's not one reason it should be down. There's not one reason the stock should have sold off on this report. You can bring up that maybe the market overpriced the Palantir thing, but I don't care, because at the end of the day, core organic growth is expanding. He just told you that the new Palantir clients are going to take like 90 to 100 days. So we haven't even got a chance to see, like, in this next earnings or whatnot, you shouldn't even expect Palantir to be in there, because he's telling you minimal 90 days. That is 3 quarters, and it just they just built on top of Palantir. So you shouldn't even expect to see anything possibly until Q4. They probably don't know how to guide for it, because, like they said, it's going to take some time. They don't know what these deals are going to happen once they're actually fully negotiated. So you can't bake a guide into it. So I think the market had hopes of this guide coming out. But as you can see in the numbers, and I noted it, like, mentally when I saw the numbers, is I was like, okay, look, this guide only looks like it was raised based off what this quarter just did. And I think this was confirmation, is they're not baking it into guide right now. They don't know what to expect. They just know, how negotiations have gone with the enterprises they already have in-house or are already working with. in which they've already negotiated with in the past. So they already formed relationships, and that's what people need to understand. They don't have formed relationships with these new enterprises, so they take time. They don't know what they're going to ask from them. It's going to take time to build that relationship. So those are my thoughts on that. But anyways, I want to thank everybody who hopped in the stream, because I'm going to wrap this up here. I have some homework to do for you guys. I have to get back to some people on X, so I'll see you guys on X. And yeah, if you guys were in the stream, let me know. Maybe you're not letting me know on here. Let me know on X. If you guys tuned in, and I'll see you guys in the next video I do. Maybe for HIMS earnings. If you guys are HIMS holders too,